recorded version as well as a copy of the PowerPoint if you guys would like it. I'm hoping that you guys will find a lot of valuable information in the training today, and I really appreciate Debbie and Julie allowing me to deliver this for you guys. If you have any questions as we go, just enter them in the chat box. I'll try to look at it and see them as we go. If not, I'll try to make sure I answer everybody's questions by the end of the training. So today we're going to be focusing on the credit bureaus, credit scoring, especially how it relates to mortgage, the problem with errors in credit reporting, tactics for raising the score quickly. I want you guys to be able to see opportunity and make sure if you are giving advice, you're giving the correct advice. We're also going to touch on some student loan issues, which are a big thing right now. Student loans obviously has the potential to be, the next big American problem, and we're already seeing a lot of issues around that. So we'll talk a little bit about that, and then of course I'll take all of your guys' questions. First, I want to talk about the credit bureaus. What their function is, and it's really important to understand that the credit bureaus make all of their money by buying and reselling our personal information. They're not very consumer-driven organizations. There's not a whole host of products and services that we want to consume as or get from the credit bureaus as consumers. There's two big misconceptions amongst consumers when it comes to the credit bureaus. One is they're somehow affiliated with the government. They have pretty official sounding names. They have the word bureau or agency attached to them. A lot of consumers confuse this for governmental or quasi-government agency. At the very least, they're really large, intimidating organizations. They're for-profit, private, multi-billion-dollar companies, just like Coca-Cola or Home Depot or anybody else. But they make all of their money by buying and reselling our personal information. And they don't even have to have our permission to do it. And the issue is when our information is being bought and resold on a daily basis for all of us just about every day, that exposes us to some bad things happening. It could be identity theft, it could be exposure to data breaches, other errors in reporting. Certainly I don't want all of my personal information being bought and resold on a daily basis. Not just because of this, but for other reasons. Right now, approximately 79% of all Americans have errors on their credit report. It doesn't mean the errors are so serious that they can't obtain lending or get the best rates and terms, but there are errors on their credit report through no fault of their own. And about 20% of Americans do have errors that affect their ability to get lending or the best rates and terms. That's a lot of people. That's about 60 million people that are being unfairly punished in the pocketbook due to errors through no fault of their own. One of the ways that I always suggest to kind of throw up a first layer of defense for yourselves, and this is something I want you guys to take to heart for yourself personally. If you haven't done this already, you need to. I've listed a website there on the screen. You can see optoutprescreen.com. So at that website, and this is a government clearinghouse, at that website you can elect to opt out from the credit bureaus. That means that your personal information, your credit information, can never be resold without your permission again, ever. And when you go there, it's going to give you a 5-year and a permanent option. You want to make sure you do both. Do the 5-year option first, because that will opt you out the quickest. About 5 business days, you'll be opted out. And then back it up with the permanent option, where you'll have to print a letter, sign the letter, and mail it to the address that's on the website. And then once they get that, that'll supersede the 5-year option that you did, and then you'll be opted out for the rest of your life. And the purpose of doing this is, like I said, it's kind of the first layer of defense for self-protection, but the big cherry on top is that your junk mail is going to go away. All of the pre-screened credit card offers and warranty offers and insurance offers and refinance offers. Also, when you're not opted out, you're subject to become a trigger lead. This is why you have borrowers who come to you and they apply for a mortgage, and then mysteriously for the next 2 weeks, they get calls from 10 other mortgage companies. That's because they're being sold off as a trigger lead. They're not opted out. And a lot of companies have standing orders to collect this information. Who all has applied for a mortgage in my area or my zip code? Who all has applied for a refinance? So I always encourage my loan officers to have these discussions with your consumers early in the process. If you can get the client to opt out early in the process, you can protect the integrity of your lead. so it's not an ongoing problem. I have a lot of loan officers who will talk with even their realtor and builder partners about this and say, hey, let's figure out a way to funnel these people or try to encourage these people to opt out. It'll protect the integrity of the lead for both of us. But not being opted out could cause some problems, and certainly, you know, it's a good way to protect yourself. And people always ask me, is there a reason not to opt out? There's no reason not to opt out. It doesn't affect your score. You don't lose availability to credit. Lenders do not know you're opted out. It's different than a fraud alert or a credit freeze. It just applies to the marketing and pre-screened offers. So credit monitoring is a hot topic. There's been a lot of data breaches in the news the last couple years, and there's many more that you probably haven't heard about. The two biggest are obviously Equifax, and where roughly half of all Americans had their personal information affected. And then, you know, because of that, Equifax had a settlement where you could choose to get 10 years of free credit monitoring or $125. The overwhelming response of most Americans was to choose the $125, which is probably not the best decision. So many people responded. The average payout on that settlement now is around $2. But if you were affected by Equifax, then the best way to check is go directly to their website. There's a lot of masquerading websites out there right now that are re-victimizing people that look like a settlement website or the Equifax website. Make sure you go to Equifax.com if you want to check and see if you're a victim. Now, all that being said, there's nothing inherently preventive about credit monitoring. Credit monitoring in itself is not going to prevent something bad from happening. It just notifies us when something does happen. So there is value in credit monitoring, and I do suggest people check their credit at least every 6 months, preferably every 3 months. But credit monitoring in and of itself is not going to be a way to protect yourself. So credit scores, because a lot of consumers are turning to credit monitoring because of identity theft issues, data breaches, errors in reporting. There's creating a lot of consumer confusion. We call it FACO scores versus FICO scores. But as a lender, you know that when a consumer comes your way, and if they mention Credit Karma to you, that probably makes your stomach drop a little bit, definitely gives you pause. The average difference between a Credit Karma score and a mortgage score is about 80 points. And the reason is all of these credit monitoring sites are owned by the 3 major credit bureaus. Karma is owned by Experian, but all the big ones are owned by the 3 credit bureaus. And they're pushing artificially inflated credit scores out to consumers. Now, why would they do that? The answer is that they want to give the consumer a false sense of complacency. If you think your scores are better than you are, you're more likely to engage in applying for credit with their real customers and their advertisers. There's a reason that every single person on Credit Karma commercial has a 720 credit score. The other reason is it kind of takes the focus off all the errors that are on credit reports. If you think your score is better than it is, maybe you're a little less likely to hold the bureaus accountable, dispute items on your credit report, and try to rectify, the wrongs that are sitting there. But the most important thing to remember is that credit bureaus in general do not have skin in the game when it comes to protecting the integrity of the data in our credit reports. It's up to us as consumers to monitor our credit, look at our credit, make sure there's no errors, and make sure that we're not victims of identity theft. The bureaus don't view that as their responsibility. Their responsibility is simply to report the information that's reported to them. But anyhow, this creates a tremendous amount of consumer confusion with your buyers, because you have to remember that a consumer who applies for a mortgage is 2 levels away from a mortgage score. They're 1 level away because they're going to a credit monitoring site that's pushing out an artificially inflated credit score, a FACO score versus FICO score, which is not even a real lender-based credit score. And then they're another level away because even if they do get a FICO score, some banks and credit card companies like Discover and USAA and other places like that are providing monthly reports or monthly scores, and they are FICO scores, but the issue is they're not mortgage FICO scores. They could be a bank FICO score or a credit card FICO score. And even within the FICO scoring model, your auto or bank or credit card score is likely 40 or 50 points higher than your mortgage score. And the reason for this is, and you can see listed on the screen here, The mortgage scores currently used by Fannie and Freddie across the three bureaus are version 2, 4, and 5. The newest one of these versions is 20 years old. None of the mortgage scoring algorithms have been updated since 1999. And they're the harshest scoring formulas, much harsher than auto lending or credit cards and industries that have moved to newer scoring formulas. Because of that, the mortgage score for 90% of consumers or more is always going to be their lowest score, and sometimes not by a little, but by a lot. It's hard to explain this to consumers, but they are 2 levels away from a mortgage score. Now, the credit bureau, and this is going to sound weird, but the credit bureaus have nothing to do with credit reporting or credit scoring. The credit bureaus are just giant data warehouses of information They collect the data, and only at the time that you apply for something is it assembled into a report. And it's not scored by the bureaus. That's why they're selling fake scores. They're not the scoring people. FICO does the scoring. FICO is a separate and independent software and analytics company. They're the ones that went to the bureaus 40 years ago and said, hey, I have a great idea. Let's create some algorithms and score all that information that you've collected and sell it to lenders for risk analysis. That's how credit scoring came about. But FICO sees the credit bureaus making $8 billion a year off credit monitoring and selling fake credit scores. And they say to themselves, well, how much money could we make if we sell real credit scores? So FICO came out with a consumer access website about 5 years ago, and I use this personally to monitor my own credit as well as my wife's. But they came out with their own consumer access website. You can see listed at the bottom here called myfico.com. When you go to myfico.com, you're going to get your real credit score, and not just one, but all versions of it. So it will show you your auto score, your credit card score, your bank score, your insurance score, your retail score, your mortgage score. And if you go there and it says your mortgage score is a 715 and you apply for the mortgage the next day, it should be a 715. It should be point for point. So we encourage a lot of our customers and consumers to go there because at some point you want to know what the real starting point is for somebody. And if you can't pull it on your side, or you need to direct yourself or somebody else to a place where it would be a soft inquiry, but they can get their real credit scores, this would be the place of choice. FICO 9. So as I mentioned, the mortgage industry is still on FICO 2, 3, and 4 across the 3 credit bureaus, and those are all 20 years old. In 2008, FICO 8 came out, and the mortgage industry was supposed to switch to FICO 8 in 2008. But what did we have happen in 2008? We had the housing crisis and the credit crunch, and the finance and mortgage industry never got around to adopting the new mortgage scoring formula. So several years go by, many years go by, and in 2015, FICO 9 came out, which is the latest scoring version that's out there right now. And both FICO 8 and FICO 9 are a lot more lenient than the mortgage scoring formulas that you guys are still working under today. Some of the differences are in the new scoring formulas, FICO 8 and FICO 9, medical bills have been devalued. They don't hurt your score near as much, whereas in your scoring formula, a simple medical bill can drop someone's score 100 points. In the old scoring formula that you're on, a singular instance of a mortgage late could drop the score over 100 points, even if the consumer's never made a late payment on anything in their life. In the newer scoring formulas, they take trended data more into account and are less harsh on the singular instance of late payment. In newer scoring formulas, small collections and collections under $100 do not affect the score. In the old scoring formulas, all collections affect the score. So there's a lot of good changes in FICO 8 and FICO 9, but in the mortgage industry, you guys cannot take advantage of it until the mortgage industry moves to a newer version of FICO. And I get asked that question from lenders all the time. Hey, Carl, when do you think we're going to move to the newer version? Well, the answer is nobody really knows, unfortunately. The rumors are they're testing the newer versions behind the scene, but you know those tests can take a couple of years to find out what the predictive analysis of the future of the new scoring formulas are and whether they want to switch over. And then once they make a decision to switch over, it could take 2 or 3 years to implement across the industry because the whole industry has to change at the same time. But what will happen when the mortgage industry moves to a new scoring formula or a newer FICO model is the average score of your borrower will go up about 30 to 40 points. That's mostly going to affect borrowers that have medical bills and singular instances of late and some of the other things we discussed. But the average borrower score will go up, yet the new scoring models are still more predictive, meaning they're doing their job. Errors in credit reporting. We touched on this at the beginning, but we're going to touch on it a little bit more. As I mentioned, 79% of Americans have errors on their credit report. And this is a staggering number. It's 4 out of 5 people. And again, I mentioned these are not people with bad credit. These are errors on their credit report through no fault of their own. And most errors aren't malicious. Most errors are due to data entry mistakes. Somebody's typing too fast. They transpose the last 2 of a social security number. They hit a junior instead of a senior on a drop-down menu. Things of the like, and maybe they have many customers with the same name and they apply the payment to the wrong customer. And the problem with errors isn't that they happen. The problem with errors is there's no efficient way to fix them for the consumers. Again, because the bureaus aren't consumer-driven organizations, that's not their priority. So oftentimes the consumer is left to fend on their own to try to figure out how to rectify misreporting and errors on their credit report. And it's a shame we're at this point because we're supposed to be protected. FCRA, or the Fair Credit Reporting Act, was actually enacted in the early 70s, around 1970. We're coming up on 50 years. It's 2019. We're almost 50 years, a half a century after this legislation was imposed, yet nobody holds the bureaus accountable, and 79% of Americans still have errors on the credit report. And there's a real cost to errors on credit report. It isn't just cosmetic. It prevents people from achieving the American dream, becoming homeowners, co-signing for family members, having credit made available to them to start a business. There's a real cost to it. And I always tell a little story at this point. You can find this on 60 Minutes. They did a special a few years ago called the Credit Bureaus Revealed. But there was a woman in Oregon who had perfect credit her entire life, never been turned down for anything, ever. And she went to co-sign for an adult child. I believe it was the first student loan, and she was turned down. And it was a real gut punch because she had never been turned down before. And this was before we had credit reports readily accessible to us. And she scrambled and found a copy of her credit report and found that there was a charge-off from a local bank that wasn't hers. In fact, she had never even done business there. So she went down to that local bank and met with them, and they agreed. They said, hey, this should not be on your credit report. It's our fault. We misreported it. And she got documentation to provide to the credit bureaus that it was an error and it shouldn't be there. With documentation from the bank, the actual people who put it on her credit report, how long do you think it took to fix on her credit report? Well, the answer is 2 years later, it was still there. Through many, many attempts and letters and calls and certified mail. And with the help of an attorney and demand letters, she was finally able to get it off 2 of the 3 bureaus after 3 years. But it still remained on the 3rd bureau, which I won't mention as Equifax, but they finally decided to sue Equifax. And when they did sue Equifax, she won an $18.6 million judgment. And the reason is because there is a real world cost. When you're denied credit and the ability to do things based on other people's mistakes, there's liability there. And so a lot of people out there are in the same situation. Because of all the errors and misreporting, many of the state's attorney general office decided, hey, this isn't fair to the consumers that live in our state. Somebody needs to hold the bureaus accountable and figure out a way that we can protect the integrity of the information on our citizens' credit reports. It was led by the state attorney's office out of New York. And so New York and many other states went after the bureaus. And what came out of that was a settlement, an out-of-court settlement. And the bureaus agreed to do many things to rectify misreporting and situations that the states viewed as being harmful to their consumers. And what came out of that is called the National Consumer Assistance Plan. It's not legislation, but it is an agreement between the bureaus and the states that these changes would be made, and most of them have been. The biggest change for you as a loan officer is that you notice that federal tax liens and civil judgments no longer report in the body of credit reports. Well, that's kind of a double-edged sword, right? Because for the consumer, who has a $30,000 tax lien or a $5,000 civil judgment from an apartment they didn't pay, they no longer see that on their credit report. And not only is it not on their credit report, it's no longer affecting their score. So they get score benefit, even though they really had those bad items. And they're like, hey, it's not on my credit report anymore. Maybe it's a good time to go apply for a mortgage. And a lot of the consumers don't know that mortgage companies are going to run a separate public records report or a CAVRS report or a Loan Guard product to search for public records. So they're not disclosing. So I want you guys to be aware of this, that there are millions and millions of consumers out there with tax liens and civil judgments that no longer show on credit reports. And you guys probably run some sort of supplemental report to see these up front, hopefully. But if you don't, a lot of the people are not disclosing them, and then it's not till later when you run that supplemental report that you find out that that's on there. And we all know that those type of items are deal killers. So the consumer gets the benefit of it not being there in the score increase, and we've just got to be careful on our side to make sure we're rooting out that information. But there were a lot of good changes under the National Consumer Assistance Plan, the public records that we just mentioned. There's enhanced dispute process for ID theft and fraud. Previously, when you put a fraud alert on your credit, it only lasted for 90 days. Now, when you put a fraud alert on your credit, it lasts for a full year. And all fraud alerts are free. There's 3 levels of fraud alert. You can do a standard fraud alert, which lasts a year. You can do extended fraud alert. If you've been a victim of identity theft, you have to provide a police report, but it'll stay on for 7 years. Or you can do an active duty military fraud alert, which will keep your credit on fraud alert when you're deployed. All of these are free, and what it does is it puts the onus on the creditors that you're applying with to make effort to verify your identity. And if you provide a phone number with your fraud alert, if anybody applies for credit in your name, they have to call you. Okay. Now, if you have been a victim of identity theft or you have more serious problems, the next level up is a credit freeze, and there's been positive changes made there too. Previously, a credit freeze would cost money to unfreeze. So consumers could freeze it, then they had to pay 10 or 12 bucks per bureau to unfreeze it. So every time they froze and unfroze, it's going to cost them $30 or $40. This made it prohibitive for people to keep their credit on freeze throughout the year. The other big issue from my mortgage partner's perspective is, hey, somebody would forget they put their credit on freeze. They would apply for a mortgage. They forgot they put it on freeze. They can't remember. They lost their PIN number. The bureaus are going to make them send copies of their IDs in, and it would take days or weeks to have a consumer unfreeze their credit report. Well, we're moving in a different direction now. The bureaus have, you have the ability to go to the bureau's website and freeze and unfreeze your credit on demand, and they only have 24 hours to unfreeze it. And it's going even more technological than that. All 3 credit bureaus have come up with mobile apps that you can download from the Google Play or iTunes store. And you would put in something like Equifax Credit Freeze mobile app, Experian Credit Freeze mobile app, TransUnion Credit Freeze mobile app. You can download these apps, and we're moving very quickly to a point where theoretically a consumer can walk into a mortgage office, unfreeze all their credit on demand, all 3 bureaus, apply for a mortgage, and 15 minutes later put their credit back on freeze. Now, how well that works at this point, I'm unsure, because it's just now being rolled out. But theoretically, that's where we're moving to. Some other changes under National Consumer Assistance Plan is there's a 180-day waiting period for medical bills to be sent to collections. This gives the consumer a chance to get notified and rectify that, because right now a lot of doctors and hospitals, if they don't get paid in 30 or 60 days, they'll just throw those bills over the wall to a collection company, who in many cases will report it on the credit without even notifying the consumer. This helps to alleviate that, to give the consumer a chance to make sure they have everything in order, recover from their hospitalization, illness, fight with their insurance company if they have to. And going forward, all medical bills that are being paid, that have been paid or are being paid by medical insurance will be automatically deleted from credit reports. They will be eligible for automatic deletions. Another big change is debts that do not originate from a contractual agreement can no longer be reported on credit reports. Well, what would that be? Well, here in Dallas-Fort Worth, we see credit reports all the time where consumers have parking tickets with the city of Dallas on the credit report. Well, those can't be on the credit report anymore because you have no contractual agreement with the city of Dallas. It could be a pet groomer, but we had gotten to the point where anybody could put anything on your credit for any reason. And so we're backing off of that. It really needs to be an original creditor that you had a contractual agreement with. Because 20 years ago, all you saw on credit reports was mortgages and cars and credit cards. And now you see everything. So that will help as well. Now, there's lots of other changes. So I pasted the website for those of you that wanted to go take a look at it and learn more information. But it's the nationalconsumerassistanceplan.com, and the website is in this PowerPoint presentation. Now, because so many people have errors on their credit report, and so many credit bureaus and credit monitoring sites have proliferated for people to have on-demand access to their credit reports, and because of the problems with identity theft and other errors in reporting, consumers have hopefully started to become more diligent about keeping an eye on their credit. What has come out of that is a phenomenon called online disputing. Now, if you're in the mortgage industry for a number of years, you know that if you saw a bunch of disputes on a credit report 15 years ago, you can be pretty sure that person was engaged in some sort of credit repair. And because of the changes in the lending industry over the last, 8 or 10 years, there's not a tolerance with a lot of loan programs and a lot of disputes to be on credit reports. Now, as a lender, when you look at a credit report, you don't know if have they engaged in credit repair. They dispute all this stuff on their own. What's happened is Credit Karma and the credit bureau websites and a lot of credit monitoring sites have decided to start encouraging consumers to dispute stuff online. The problem with this is when you dispute things online, you waive your rights under the Fair Credit Reporting Act. It's not effective. If a consumer disputes something on their credit report, it needs to be done the right way. It has to be done with proof, with documentation, through written correspondence, by certified mail. But this has caused a real problem because everybody and their brother now wants to dispute everything on their credit report, which is not a strategy for improving your credit or improving your scores. Disputing is just disputing, and it causes lots of problems. And in a lot of cases, consumers can do more harm than good because what temporary effect they get by a few items coming off their credit report is lost when those items are reinserted on their credit report with new dates, and now their scores are lower. Because we know in the credit industry that date drives credit score. It's not the type of item that drives your credit score. It's always the date that drives your credit score. Credit is a what have you done for me lately world. That's why a bankruptcy from 6 years ago might only be affecting your score 10 points, but a $30 medical bill from last month could be affecting your score 100 points, right? One's worse than the other, but it's the date that drives credit score. So some common credit myths, we know, I know most of you guys know, but consumers don't always know, because I get this question all the time, does me not having a debit or a credit card or a debit card with my bank affect my credit score? Not having a job, how much money I have in my bank account? We all know that, race, religion, all that stuff, age, bank, no personal information ever affects credit score, ever. So it's important to always communicate that to consumer if they ask. We also know, if you're a loan officer and you've been around for a while, that paying third-party debt collectors does not affect credit score. In the credit scoring formulas, all credit scoring formulas, a paid collection is graded the exact same amount as an unpaid collection. So the balance on collections does not drive score. Again, only the date drives score. So we know that consumers, from a credit score perspective and from a credit rehab perspective, should not be paying third-party debt collectors in an effort to raise their score. Now that takes out the moral and ethical contingent of paying your debts. If a consumer wants to pay a third-party debt collector for moral and ethical reasons, and they feel like they should pay it, then they should pay it. You just need to know that it could negatively affect their score by updating the date, and it's not a strategy for raising their scores. So we want consumers to focus on original creditors. It's always good in general terms to pay original creditor debt, whether it's open, closed, or charged off, versus third-party debt where you never really had a relationship with. It's not going to affect the score, but that's the two most common remarks we get from consumers. I paid that. Why is it still on my credit report? I paid that. How come my score didn't go up? And the root of the problem is that consumers view their credit reports as balance sheets, right? Credit reports are not balance sheets. Credit reports are a reflection of payment history and credit worthiness over 7 to 10 years. But that's not the way consumers view it. They go through a rough time in life. They have lots of collections, late payments, bad items on their credit report. They're doing better. They get a great job. They're paying all their bills on time. And a couple years later, they're like, hey, you know what? I want to go buy a house. And to get prepared to go buy a house, I'm going to go clear off my balance sheet. I'm going to go pay all these old debts. And they're throwing good money after bad money, and their score's not improving. And they're wondering why. And it's because they view their credit report as a balance sheet. It's still on your credit report when you pay a collection because it happened. That's what the credit scoring system is designed to do, is record events over 7 to 10 years. You don't get bonus points for paying it 4 years after it went to collections. Therefore, your score doesn't go up. Checking my credit will hurt my score. Well, again, a lot of consumers don't understand that the only time your score is ever affected is when you apply for lending, such as a mortgage, a car, credit card, an apartment lease. When you're applying for an extension of credit, that's the only time it ever affects your credit score. When it comes to other types of inquiries, those are all soft inquiries, and they do not affect your credit score. And we'll go over those in a moment. I'm going to give you guys the real deal on inquiries, because one of the #1 things I get from loan officers' question is, what is the window that a consumer can pull their mortgage in and still count as one inquiry? The deduplication process. And I think the answer will surprise you guys. Child support. I throw this in here because this is just an interesting little factoid or nugget that really nobody knows. I can guarantee you that 99.99% of loan officers don't know this, and it's actually a flaw in the old mortgage scoring formula that you guys are working on. It's been addressed in the new scoring formulas. But in the old mortgage scoring formula, they didn't account for child support. So right now, if you have a consumer with child support on their credit, it does not affect their score. There is no accounting for child support in the mortgage scoring formula. So if it's, obviously most of us are in Texas. In Texas, it's the Office of the Attorney General. So you may see OAG on a credit report. If there's an OAG entry or the state reporting entity for any other state on a credit report, it is not affecting score. It doesn't matter if it's 120 days late, a collection, whatever. It's not affecting score if it's entered by the state reporting agency. Now, if they sell it off to a third-party debt collector, then it would affect the score, because then it's treated like any other collection. Now, the reason most people don't notice this is because usually people who are not paying child support are not paying a bunch of other stuff and probably have pretty bad credit. So it hides the fact that that's not, counting in. But theoretically, it would be possible for you to have a consumer with a 760 credit score, a mortgage, a couple cars and credit cards paid on time, and the only negative remark being 30, 60, 90 days behind on their child support, and still be a 760 credit score, because it would not be affecting their credit. Of course, we know to get a mortgage, you've got to be up to date on your child support, so that's a different issue. And so luckily, at least it's on there so that you guys can see that. We already talked about opt-out pre-screen, but if you've been around for a while, 12, 15 years ago when opt-out pre-screen first came out, that a lot of lenders were telling consumers that if you opted out, that it would positively impact your credit score. This is absolutely not true. Again, there's no mechanism for opting out to affect credit score, so it's physically impossible. But I know a lot of lenders that still today believe if somebody opts out or raise their credit score, but you need to know that it doesn't. But the other reasons for opt-out, which we already discussed, is why you should encourage them to opt out. Look at this. This is the dreaded credit pie chart, which you've all probably seen many, many times. These are, there's thousands of factors that go into these FICO scoring formulas, but they all roll up more or less to one of 5 categories. Payment history, 35%. The most penal thing on a credit report is always going to be recent late payments. Being in the field, recent late payments are score killers. And it's always going to be the #1 score driver. So payment history. The next category, amounts owed, that's misleading. It's not really amounts owed, right? Because you're not penalized for how much you owe. People confuse debt with credit. Do not confuse debt with credit. For example, If you have $1,000,000 house, you're not penalized for having more debt than somebody with $100,000 house. It's installment credit, and the only thing that matters on installment credit is it paid on time? Can you service that debt? So is it really amounts owed? And the same goes for revolving credit. In revolving credit, you're graded on your utilization percentage. What percentage of available credit are you using, right? But let's say I have three $1,000 cards that are maxed out, and Debbie has three $50,000 cards that got $10,000 each on it. Her score is going to be 70 points higher, even though she has $30,000 of debt and I only have three. She has 10 times the amount of debt, but she's only using 20% and I'm using 100%. So I'm losing 60 or 70 points. So, you know, balances are a huge score driver, but it's percentage, not total balances. Length of credit history, 15%. People with high FICO achievers are people that keep the same sets of accounts open for long periods of time. You know, people ask me all the time, how do I have an 800 credit score? Pay your bills on time, have enough open credit, and keep the balances below 20%. That's it. And have the same set of accounts open for many years. I've got 3 credit cards. My newest credit card is 16 years old. That's, you know, when you open and close accounts all the time, you're subject to inquiries and scores going up and down. But when you protect your credit, you have it pulled less often, you have the same sets of account open for long periods of time. That's how you achieve 800 credit scores. New credit, 10%, which is really another name for inquiries. How much new credit are you applying for? Are you desperate for credit? And then 10% types of credit used. And types of credit used is only 10%, but you get points for having every box checked. And there's 3 boxes: the mortgage credit, installment credit, and revolving credit. So all things being equal, if I have 2 cars and 3 credit cards and you have 2 cars and 3 credit cards, and the only difference is you have a mortgage, your score is going to be a lot higher because you have the mortgage box checked and I don't. And vice versa with the other types of credit. Maybe I have 3 credit cards and you have no credit cards. My score is going to be higher because you don't engage in revolving credit. And again, people will confuse debt with credit and say, hey, how come I have to have debt to have good credit? You don't have to have debt to have good credit, but you do have to have credit to have good credit. That makes sense. It's just a game, and you want to check the boxes. Inquiries. So we already talked about soft inquiries versus hard inquiries. Types of soft inquiries that do not affect scores: checking your own credit, so MyFICO, Karma, any self-checking credit; employment and insurance applications; promotional inquiries; trigger leads; existing account review; background checks; security clearance; employment screens, all of that. Even collection companies can check your credit. If you have a collection, that collection company can check your credit anytime they want. It is a permissible purpose because they're collecting on a debt. Now, it will not affect your credit score, but they can do it. Only when you apply for an extension of credit will it be a hard inquiry. So if you're applying for a car or a mortgage or a student loan, those are hard inquiries. But there's a process called deduplication. And the deduplication allows the consumer to shop for the best rates and terms. We as consumers should have the right to shop for the best rates and terms, get the best deal on a mortgage or a car or a student loan. It only applies to those 3 categories: mortgage, auto, and student loans. In the newer scoring formulas, FICO 8 and FICO 9, the window is 45 days across all 3 bureaus. In the mortgage scoring formula, nobody really knows if it's 15 days or 30 or 45. Well, I'm going to give you the straight answer. The straight answer is this. On Experian, your mortgage window is 14 days. In the other 2 bureaus, Equifax and Experian, your window is, or Equifax and TransUnion, your window is 45 days. So there is no right answer. It's not 15 or 45 or 30 for the mortgage industry. It's 45 on 2 bureaus and just 14 on Experian. Now, I don't know if I would go in that much detail and trying to explain that to a consumer. I think I would be just comfortable saying, hey, the window's 45 days because only on 1 bureau is it not, and it doesn't affect their mid score. But at the same time, if you want to disclose that to a consumer, that's the real answer. But I think for 99% of us, 99% of the time, for 99% of the things we're trying to do, you can know that the window for deduplication is 45 days. It works in mortgage because when you apply for a mortgage, it's coded as a mortgage pool. It also works in student loans. It does not work in auto because when you go to a car dealership and they pull your auto credit, that's one hit. If you go to another dealership and they do the same thing, it's deduplicated. But if you're in an auto dealership and they send it out to their network of banks and credit unions, which they try to do a lot because they want to get you the best rate or get you a lower payment or get you into a nicer car and upsell you, they send it out to all of their banks and credit unions. Those are coded as general inquiries. Now all of a sudden you've got 30 separate inquiries on your report because you went car shopping over the weekend. I've seen people's score drop 60, 80, 100 points just on car shopping over the weekend, and it takes months and months and months for the effect of that to go away. So as a general rule of thumb, it's always great, and we do, and it's always great to tell your borrowers, do not ever go car shopping. Even if you're not going to buy a car, go car shopping during the home buying process. We'll talk about utilization ratio real quick. We talked about balances a while ago being a huge score driver. And I want to let you know that the correct percentage is 1 to 19%. You know, 10, 15 years ago when I got in this business, all the mortgage people said, hey, get all your balances below 50%. And that's good advice, and it helped the score. And then it was like, hey, get all your balances down to 30%, the 1/3 rule. And that was even better advice, even better score. But we know that the lower the balances, the higher the score. So the best is 1 to 19%. That's the lowest bucket. It's better than 30 and better than 50. So the ideal utilization rate individually and across all of your revolving accounts is 1 to 19%. Again, this does not affect installment credit, only revolving. But it's across the aggregate. So it's the total amount of your revolving balances versus the total amount of your available limits. And you're graded across the aggregate. There's very little scoring emphasis put on the individual account. For example, if I had a $10,000 card and 2 $500 cards that were maxed out, but the $10,000 card was paid off, I have just about the best credit score I could go because across the aggregate, I'm less than 10% utilized. So advising that customer to pay off 2 maxed out credit cards of $500 looks good on the surface, but it's not really going to raise their score because you're not looking at the aggregate. This is a common mistake a lot of lenders make. You got to look at the aggregate. So 1 to 19% is always going to get the best credit score. And there's a couple of ways to affect utilization ratio. One's to pay down balances, and one is to raise limits. It's always in your best interest to have the highest limits possible. That way, when you do use your credit, you're impacting your ratio the least amount. But so it's the total balances versus the total amount of limits across the aggregate. You want to keep it 1 to 19%. Now, some people will say, well, 6% or 7% or 8% is the ideal, and that's true. I think 7% is the recognized absolute ideal percentage, but we're talking like 1 point, right? And you'll hear a lot of people say it's better to keep small balances on your credit cards instead of paying them off. And again, that's true, but we're talking about 1 or 2 points. If you've got good credit, there's no reason to keep small balances on your credit report. It might be the difference between being 760 and 762. It's not worth the trouble. But on young people, millennials, first-time home buyers, and people who have had credit issues that you're advising and trying to help get across the finish line, every point matters. It's always good to instruct those people to keep a small balance below, in 1 to 19%, but small as possible on those open revolving accounts. It'll get you that extra couple points. And there is a small individual component, but it's again small. So if you always want to make sure you have the absolute best credit score possible, keep your individual cards and your aggregates below between 1 to 19%. You'll always be assured of having the best credit score. Trended data, I'm going to address this really quick. I'm sure you guys have heard of and been made aware of trended data. Trended data is not really, in most instances, affecting a consumer's ability to get a loan right now. The official stance is that no consumer who was approved before has ever been turned down for a loan because of trended data. Now, I've heard of possible instances where that has happened with an individual underwriter or company, but as an industry, we're not really using trended data at this point, even though you've already seen it on credit reports where they're showing you 2 years of pay history on certain types of accounts. And the reason they're doing this is because we're going to be moving towards trended data in the new scoring models in the future. It will actually affect your score. Right now, your score is not affected by trended data. Right now, the only thing that affects a credit score is what are your balances the day they pull the credit report. So theoretically, a consumer can have two maxed out credit cards for a year, 2 years. At the instruction of someone, pay down those cards below 20%. Their score pops up 60 points. They get into the house, and then 3 months later, the credit cards are maxed out again, right? And so that person is called a revolver. They're always carrying high balances or near full utilization on their cards. They're maybe occasionally paying late. Sometimes they're going over the limit. But a revolver is a minimum payment payer. A transactor is somebody who's paying their cards off in full every month or always keeping their balances below 20%. And the reason the mortgage industry wants to delineate between a revolver and a transactor is because they've done lots of studies. And all things being equal, whether it's score or types of credit or whatever, all things being equal, a revolver is 7 times more likely to default on a mortgage loan than a transactor. So they want to root that information out. So probably not in the near future, but in the next few years, I wouldn't be surprised to see the new FICO scoring models grade you based on average balances of your account over a certain amount of time. And the mortgage scoring formula will go that too. That way, they'll see more of a true reflection of how people manage their credit over time and not just last month. But that's why they're trying to get to that information, is because of the default rate. Delete, I'm sure many of you guys have heard of pay for delete. It's an increasingly popular phenomenon in the last few years. About 30% of collection companies will do it. I would not, as a loan officer, instruct your customer to do a pay for delete. Absolutely 100% sure that it's going to get you the desired effect. But a pay for delete is when a consumer will call a collection company and agree to pay that collection only if it's deleted off their credit report. We've already established the fact earlier that paying a collection in of itself will not raise the credit score. But if it was not on the credit report, that certainly would raise the credit score. Really, only about 30% of collection companies are doing it, and it's mainly medical collection companies. Technically, they're not supposed to be doing it because it's against their agreement with the credit bureaus. Because again, payment should not be the factor for deleting something off somebody's credit report. If that was the case, people could just pay everything on their credit report, hide the fact they ever had bad credit, and we wouldn't even need a credit scoring system. But if I'm a consumer and a cell phone company for $150 hits my credit, drops my score 75 points, and they're willing to delete it, and I can get that 75 points back, I'm probably going to do it. If a consumer does engage in a pay for delete, it's a tactic you really only want to use on a singular or 1 or 2 recent collections. If they've got a bunch of collections, they shouldn't be trying to do pay for deletes, or on old collections either, because it's not really driving the score. But a very recent singular collection is a perfect candidate for a pay for delete, and if they're willing to do it, the consumer should do it. Collection companies have amnesia, so the consumer must say to them, hey, I need a letter saying this item is going to be deleted off my credit report, deleted or removed from each of the 3 credit bureaus upon payment. They must list out the account and the account number, and they must use that terminology, pay for delete, because the collection companies will have amnesia, and they will lie to consumers and say, oh, sure, pay it. We'll update it on your credit report. And by update, they mean show paid or updated, which does not help the score. It must be deleted, and that would be the only time it's worth it for a consumer to pay a collection company. But again, I would use that tactic very sparingly. And as a loan officer, you got to be careful, because anytime you ask a consumer to pay something or do something and it costs them $1 and it doesn't result in the desired score increase or home loan approval, guess who they're going to blame? And you don't want it to be you. Goodwill deletion is the same thing for recent late payments. We know that recent late payments are score killers. I had a client recently. She had a 740 credit score, and her husband and her are good friends of mine. They were doing a jumbo loan. Macy's reported her late when they went to repull credit, and her score dropped from 740 to 660, and she was no longer qualified for that loan for one late payment on Macy's. And so a goodwill deletion is the strategy of basically asking the creditor to remove the singular instance of late payment based on your good pay history. You're basically asking them to do you a favor. It's a tactic that only can be used for the single instance of recent late payment with original creditor. No point in doing it on old late payments. They're not going to go back and do it. It wouldn't really help the score that much anyway. If you had 4 other late payments with Capital One last year, they're not going to remove a late payment for you this year. But in that single instance of late where something truly slipped through the cracks, you were on vacation, you changed payment methods, something like that, then it works a surprisingly amount of time. The creditor will, the consumer will call up their creditor, and this is what I had this woman do. She says, Carl, I've already called them 3 times. They won't do anything for me. I said, you must ask to speak with somebody in the credit department. Customer service will never, ever do anything for you. They'll just tell you it's not possible. So she asked for somebody in the credit department. She used the terminology goodwill deletion, which I told her to use. And then I told her exactly what to say. Hey, my name is so-and-so. I have a late payment on my credit from Macy's from a couple months ago. I've been a valued customer for 7 years. I've never made a late payment. This was an oversight on my part. I'm trying to get a home loan, and I'm asking for you to do a goodwill deletion. And they agreed to do it within 5 minutes, sent her a letter, and save that deal. So this is something consumers can do that's very easy. It's not gonna help with multiple lates or old lates, but with that one late payment that's driving your score 60, 80 points, it's always worth a try. Again, they need to try to obtain a deletion letter if possible. You can't really push the subject because they're doing you a favor. You can push it a little more on the pay for delete for collections, but in both instances, whether it's on the pay for delete or the goodwill deletion, what is the point of getting that letter? The point is now they have proof they can go back to the bureaus if they do get amnesia and don't correct it, and or as a mortgage lender, you can use that documentation to rescore instead of waiting 30 to 45 days for it to update with the bureaus, right? All right, the last subject I'm going to talk about before we talk about student loans, and we've got about 5 minutes, is authorized user accounts. I want you guys to be very, very careful. Authorized user accounts, again, should be used very sparingly. They're only used, well, let me put it this way. There was rumors that authorized user was going away in 2008, and indeed they have been devalued a little in the newer scoring formulas, and they've put protections in place in the new scoring formulas where it needs to be a family member with the last name or a spouse or somebody that lives at the same address, and they're trying to root out mortgage fraud. So authorized user is still a totally 100% honest, ethical way to help improve your credit score if it is done with a family member, a spouse, a sibling, or a parent. But there are a lot of credit repair companies out there and other devious individuals who will encourage loan officers and consumers to get on strangers' credit cards. It's called piggybacking, and it's absolutely mortgage fraud. I want you guys to stay away from it. If you know about it, it's mortgage fraud, and you can get in trouble. I get emailed a list of credit cards from a company in Florida every week that range from a $200 Capital One card that's been open 6 months to a $50,000 Amex card that's been open 25 years, that range from $200 to $3,000 cost to the consumer to add them on. And essentially what the consumers are doing, or these companies are doing, is they're adding themselves onto these cards. They're adding themselves onto these cards to get a temporary jump in score, taking themselves off next month. So they went from 550 to 650, got a home loan and back to 550. That is mortgage fraud. So authorized user is okay if it's a family member, but do not, if you hear of a customer doing that, they cannot do that with strangers and sold trade lines that they have to purchase. That's not ethical. It must be a family member, should be an account open with longest history possible, 5 years or longer. The higher the limit, the better. Utilization ratio below 20%, and account never paid late. We got to meet all the criteria we would want to meet for our own card to make it an effective authorized user, but we can still see 30, 40, 50 points score increase on a parent's credit card. We just want to make sure that's not their only source of positive credit, because some underwriters and mortgage companies will not accept that. But usually if they've got some of their own credit and this is supplemental to help get some history, they're okay with it. but that's up to the mortgage company, but it's still a very effective tool. Building credit thin files, secured credit cards are a good starting point. We want to check all those boxes: revolving, installment, and eventually mortgage. We want to always start as 3 open trade lines as a base, preferably 2 revolving. Reporting a score, you must have at least 1 open trade line reporting within the last 6 months. When you see a no score, you see a credit report saying file not scored due to insufficient credit, that's because they haven't had at least 1 open trade line reported in the last 6 months. And it's got to report for a minimum of 6 consecutive months to generate a score. That's why it can take up to 6 months when they go to 0 and now they've got to rebuild a score, or they've never had credit and they've got to build a score. That's why it can take up to 6 months to get a score, because that's the requirement to generate a score. You cannot report a score as deceased, but we see this all the time where people are very much alive and being reported deceased, so their credit reports have no scores on it. And that's a big pain in the butt, obviously, to deal with the bureaus and try to show, and can take several weeks or a couple months to prove that you're not deceased. But FICO score models look for length and depth of credit, and that's what we're always trying to achieve once we get a score. Long history and diverse credit. All right, lastly, student loan statistics, and this is going to blow your mind. Total student loan debt 10 years ago was about $250 billion. As of a few months ago, we're at $1.56 trillion, 6 times the amount as before. All in the last 8 years, the federal government has been shoving student loan debt down consumers' throat for a decade now. And as a result of it, it's going to delay home ownership for a generation of people. 44.7 million U.S. borrowers have student loan debt, and of that, 5.1 million are in default, over a year in default, delinquent, collections, and wage garnishment. Another 10 million, so over 15 million, are currently in default or behind. So a third of all student loan holders are currently not repaying, and they estimate in the next 5 years, or not even the next 5 years, I think in the next 3 years, that over 50% of all student loan holders will be in default or late. They just simply can't pay them. It's too much. And you know, there's consumer responsibility, so there's bad decisions in that as well. But the biggest stakeholder in the servicers are the universities who up tuition every year, and the servicers collect money every year, and the federal government, because they guarantee these student loans, makes tremendous amount of profit every year. I think last year, the federal government made over $50 billion in student loan repayment, and that's with a third of all people not paying. So the average amount of student loan debt goes up $2,000 for each graduating class. And now, as of recently, total student loan debt exceeds all credit card and auto loan debt in the U.S. combined. Think about that. That is staggering. And the average length of repayment for student loan borrowers is 21 years. There's a reason they can't get a house. They've already got a mortgage on their credit report. It's called their student loans. Repayment terms are 20, 25, sometimes 30 years at a higher interest rate than a mortgage, and in a lot of cases with an amount similar to a mortgage. So it's very, very, very difficult. You know, there's solutions out there. I think I talked to you guys about them when I was in Dallas, but there, you know, if you're up against it on the 1% for FHA, there's some help to be had there. There's a way to get a fully amortized payment at about 0.6%. But you know, it's a really, really big problem. And if you ever have questions about student loans, you can reach out to me. I'll have all of my contact information at the end of this presentation. Anyway, we're around if you need our help. We have some unique resources like rent reporting for our mortgage partners. We have lines of credit and installment credit we can help your customers obtain. We've got educational things we do. We're TREC certified. So for some of the Certainty offices, I have delivered already CE classes for realtors to help them grow and expand their business. So in whatever way you think I could be useful for you, I would love to earn your business and be a partner to you. All of my contact information is here. My email and a link to my website. On my website, there's a resources tab where you can find our secured credit cards, rent reporting, credit monitoring, and other ways for consumers to rebuild positive credit if they need to. They don't have to be a customer of ours. That's open to the general public and any of your customers. And I just really appreciate Debbie and Julie letting me train you guys on credit today. And I hope you guys found the information useful and you learned a lot. I did record the webinar, so I'm going to provide that to Debbie. I'm also going to provide her a copy of my PowerPoint presentation if you think it's useful. And right now, I'm just going to ask all of you, are there any questions you have about anything we went over? Or do you have a question that I didn't talk about today about credit that you've always wanted to know the answer to? You can ask on the phone, or you can, hold on, let me see if I can. You can ask on the phone, or you can type in a question. If I don't get a question from anybody, I'll just thank you all very much for your time, and hopefully you all found it very useful. Debbie, did you want to say anything before we go?
I think it was wonderful. It was a great refresher on getting more of a focus on just credit lines and how it affects your score. But I thank you so much, Carl, for your time today. I really appreciate it, and I look forward to getting that PowerPoint and information from you.
Yep, I'll get everything sent over to you today. I really appreciate the time, and I tried to get everything I could in an hour. But if you guys have any questions about anything or you need anything, just feel free to reach out to me, okay?
Absolutely. Thank you again, Carl. Appreciate it.
All right, guys. Everybody have a wonderful day.
All right, you
too. As gloomy as it is. All right, thank you.
Okay. Bye-bye.
Bye-bye. Mm-hmm.